this is the actual, uncollectible or bad debts happened. So $2,700 is not going to be received in December. And we estimated the allowance based on percentage of sale method, which is 1%. So all you need to do, record the entries. So they said, okay, we need to first generalize the sales. So in what is the entry for sales for 159,000, entry would be accounts receivable to sales. Collection 130,000, cash to accounts receivable, right? Now, what will happen to the write-off? Write-off will always, we charge the actual write-off, we charge the actual uncollectible to allowance, because we set up the percentage of sale account, percentage of sales method of the allowance. So anything that actual happened, we charge it to the allowance. So 2,700 is going to be decreased from account receivable, and we charge this to allowance. So increase in allowance mean credit, decrease in allowance mean debit, because opposite, the allowance is the opposite for account receivable. So this 2,700 will decrease the accounts receivable. Decrease in accounts receivable mean credit. We charge it to the allowance. Decrease in allowance mean debit. So allowance to account receivable, right? So when we set up 1% of credit sales, what will be the allowance? So we already in advance, this is estimated, we already in advance make, we already made the allowance based on 1% of sale. So 1% of 159,000 would be 1,590. So we already expense 1,590 and we set up allowance. So entry would be expense to allowance. So anything happen now, actual, we will charge it to the allowance, not the expense, because expense, we already recorded 1,590 in advance, right? The second part here. Show how High Peaks party planners will report account receivables and net sales on December 31st on balance sheet and income statement. So this is how our balance sheet and income statement will look like. So if you net it off here, we have the balance here. 159,000 is the credit sales, 130,000 is we already collected, 2,700 is uncollectible, balance would be 60,300. So if you see here on the balance sheet, so you see account receivable would be 60,300, allowance would be 1,890, and net account receivable would be 58,410. Simple. Account receivable balance minus allowance for account receivable. Net would be 58,410. That's it. So this amount, net amount, won't be disturbed until we have uncollectible that is more than 1,890. If uncollectible are 1,900, then the net amount is going to be disturbed. So smart managers, they plan in advance so that their decision, if you are basing on your decision on total assets, so total assets remain the same so that your decisions won't impact your further second-hand decisions or third-hand decisions or fourth-hand decisions, right? Sometimes you need to plan based on your net assets, right? So you create allowance so that your net amount is not going to be disturbed. So you have a room for further loss of $1,890. If loss is more than that, uncollectible loss is more than that, then your planning is going to be disturbed, and then you are answerable for this one. And then the management will call you, look, why the uncollectible is more than our expectation. Then you go deep dive into the cause. Maybe our collection policy is not good. Maybe we allow more credit to unworthy customer. Maybe the whole economy is going down and we are having bad times in our country, right? So this is like that. So on balance sheet on December, sale will be written 159,000, right? Collection is nothing to do with sales. Collection is to do with account receivable, right? This is how we present our information to balance sheet and income statement. So direct write-off methods, it is not recommended in GAAP because the generally accepted accounting principles, they want you to be smart, professional. So they allow you to, allowance method to do that one. If you direct write-off, that is not recommended. In direct write-off, what you do, you don't create allowance method. If any loss happened, you charge it to directly the account receivable. For example, your account receivable was 159,000, right? 2,700, 3,000 is not going to be received. So you say, okay, uncollectible expense, you see expense, uncollectible expense to account receivable. So just 3,000 you left, just decrease here. Answer would be 15600. So that would be your account receivable on balance sheet, net account receivable. So earlier the account receivable balance was 159,000 and now it is 156,000. You don't create any allowance. So this is not recommended. See, if RS, you don't establish any allowance method, entry would be you just, that is loss, expense to account receivable. That's it. And that is not recommended by law. Now, computing for cash collections. So recording revenue on the account, simple. If sale happen, right? What would be the entry? Account receivable to revenue, right? So my question is, okay, wait, here. So how we are computing the cash collection? Simple. Cash collection is basically you can rearrange. We already talked about this, but just you need to rearrange. If we are not given this amount and we are given the balance here, so can we find out this amount? Yes. How? The debit side must be greater than $400 from the credit side. So it means on the debit side, this is the beginning balance, this is a sale, and we are also given the 100 as a write-off. So the balance of 1,500 is basically the cash collection from customers. Because accounts receivable going to be decreased by two things, either the uncollectible or either cash collection, right? So let me repeat one more time. The account receivable is going to be decreased only in two ways. Number one, if somebody is not paying you, if somebody is paid you. Simple. If somebody has paid you, we call this cash collection. If somebody is not paying you, we also need to decrease our account receivable, and that is called uncollectible or bad debts or write-off. Different names, right? So we can find out, even though we are not given the amount for cash collection, we can also rearrange this debit and credit side. We can find out how much customer has paid you. This is extrapolation. We can do that through equation or through debit and credit side, right? Yeah, we can solve because the receivable account have 5 items: beginning balance, credit sales, ending balance, write-off, and customer collection, right? This is just we have explained. And now how we account for notes receivable. The only difference in note receivable is we also receive interest, right? So let's just talk about this. So the terms and condition, we already talked about that. In note receivable, we have the name of creditors, we have name of debtors, we have interest because we are lending you money for some period of time, we have the maturity date, maturity value. At the end of the month, you will be giving me this much amount. So maturity value would be equal to, I'm giving you $100,000 and you need to give me 100 interest. So it means you need to give me 100,000 and 100,000 and $100, right? Term is going to be like, you can include that, okay, you signed it and it must be, paid within the period. It's like that. So how you account for this is a typical promissory note. It is written on company's letterpad. It's a legal document. You can challenge it through court. So you see, it's a promissory note. Maturity date will be given. Amount is given, right? 1,000. So it says that for value received, I promise to pay the order of, you make payment, you attach a check here. Okay, we are paying you payment through bank account. So you just write it down the bank account and you mention the interest rate as well. So this interest is 9% is annual, right? And if you are, so how much months, how much days occurred, you just multiply according to find out, okay, it's 2 months, then 2 by 12, 1 month, 1 by 12, 6 months, 6 by 12. You multiply the interest rate with that. If 1 month, you multiply by 1 by 12, 9%. If this is 2 months, so 2 by 12 of the 9%. If 6 months, 6 by 12 of the 9%. You multiply with the amount here, you add it, that is the maturity value. Let's just talk about this. We already talked about this interest period, interest rate, everything would be given to you, maturity date. And we are more interested in the entries, right? You signed it, so that is the term and condition. Here we go. So here we go. So we have a promissory note, so that Lauren Holland signs, and the Continental Bank gives her 1,000 cash. The bank makes the following entry. So in this case, the party is bank, right? So it means bank is giving us some kind of cash as a promissory note, as a note receivable. So what would be the entry? So consider promissory note. After Lauren signs the note, Continental Bank gives her 1,000 cash. The banks make the following entry. The banks makes the following entry, right? Here the company is bank. So not the business, not the Lawrence, bank. So when banks gives her cash is decreased from the bank, right? Decreased from the bank. So that's why, because most of the students, they just confuse. They say that, okay, Lauren received cash would be increased. We are making this entry with perspective of bank. So cash is going out from the bank. Cash decrease, credit. And Lawrence Holland is categorized at notes receivable, not account receivable, notes receivable, right? So what happened here? After 6 months, it is 6 months, or September to December, 3 months. So how much is the interest in 3 months? Or it's 4 months? September. Okay, 1st of September. September, October, November, December, 4 months. So 9%, 9% multiplied by 4 by 12. Principal amount is 1,000, so answer would be $30. So when 31st December, when this note is going to be due, he has to pay us 1,030, right? 30 is the interest. So what happened in 4 months? How to record the interest? So we are making this on the basis of bank's perspective. Bank will receive the interest, right? Entry would be bank is, when will receive the interest. So interest would be revenue for the bank. Entry would be interest receivable to interest revenue. Interest revenue. Increase mean like sales. 30, and